wanted to do today is I wanted to show you some advanced things that I'm doing, because what I'm going to show you is actually a plan that I'm doing right now to take care of many things in my life, not only buying real estate, but it's to show you how I'm going to use it to fund Viviana's college or whatever she decides to do. I'm going to show you how I'm going to use it for a supplemental retirement plan. And then I'm really going to talk about rates of return and how this will work from a return standpoint. So if you've seen the presentation, the main presentation I do, you will know that that main presentation shows you how to use this system, shows you how to get all the money back for all the cars you're going to buy, drive, and own, how to use it to pay off debt. And the one thing it does is it uses our main workhorse, okay, that specially designed banking policy. It shows you how to use that with the main one that we do. I'm going to show you a different vehicle today because we really have two different designs we can do. We can do the one that you've been seeing, or we can do this one. Now, this one will look really, really good in the short run, like in the first, few years in the plan. But if I were to show you this plan you're going to see today, okay, and I laid it next to the plans that we normally design that you saw in the main presentation, what you're going to see is a drastic difference later on. The plans that we do where you have 60 to 70% of your money available in year one, that's our main plan, right? You have 60 to 70% of your money to use in the first year. That, some people, they look at that and they say, well, I don't really like that because I want access to more money. Because a real estate investor, for example, I have a use to use that money now, and I'd rather have 90% of my money available versus 60 or 70, and I'm willing to give up a little later. So if I ran both of the plans together, what you'd see is the plan you're going to see today is much better for the sprint, the short run, for somebody that can take the plan, make deposits, larger deposits, and then take those deposits and that money and immediately put that money to work, maybe into a real estate deal, for example. This plan would work better for them because they can make the money on what they're doing with the banking side of it versus what the machine's going to do later. So I just want to be clear that that's how we're going to do this. Now, let's jump right in. So I'm going to skip by some slides. I didn't know who I was going to have, and I didn't know if everybody had already seen the presentation. So I kind of did a hybrid presentation here, and I included my video, this stuff. But you guys have all seen this, and you guys already know these statistics, but I'm just going to do a quick overview. So you guys are part of the 5%ers because you were willing to do what everyone else was unwilling to do. There's the other 95% of the people that aren't on this training that you know should be on this training. They're not here. They're doing something else. You're the 5%. You're willing to do what everyone else is unwilling to do, which is investing your time, your energy, your effort to learn something new. And if we just look, that 5% really comes from this. Social Security says this. They say that 5 out of every 100 people will be financially secure at the age of retirement. Think about that. Really, like out of 100 people that you know, let's say you put everybody in a room, there's only going to be 5 of them that are going to be financially secure at the age of retirement. Do you guys see a problem with that? Because I sure do. I see a lot of 65, 75, and 85-year-olds working into the retirement, not because they want to, but because they have to. And that's primarily because they simply were never taught how to make money work for them. Now, that's not the case for every one of them, but I bet you that number would be much higher if somewhere in our lives we were taught the things that we're showing you how to do. If someone taught you how to make your money work for you, if someone taught you how to change that one thing in your life that now allowed you to pay yourself first and pay everybody back with weaker dollars, that would change your life. You guys already know my story. Obviously, grew up very humble, became a pro snowboarder, opened a chain of snowboard shops, then became a financial advisor in the early 2000s, lost it all in 2008. And I was doing really well. And I lost it all, but my beautiful wife, Larissa, right there in the middle, who's not, was my girlfriend then, agreed to help pay the mortgage, the utilities, and allowed me to move 2 of my friends in to rent bedrooms in my house so I could make it through that time. Got all the way back up. In 14, got back on my feet, had 36 rental units that I bought during 9 to 14. And then in 14, because I didn't know what I didn't know, because I didn't know what Will Rogers always says, and he says the problem in America is not what people don't know. That was my problem, is what I didn't know. The problem is what people think they know that just ain't so. See, in 2009 to 14, I'd been using all the traditional conventional financial knowledge that I had been taught as an advisor, that I'd been taught by all the people that I was surrounding myself with. And it was, when I buy a property, I'd just go buy it in my personal name. And I finance it in my personal name, thinking, oh, I got this, it's a lower interest rate. Well, in 2014, the bank decided that that wasn't part of their little square box. And when I brought the 37th unit to them, the 37th property, they said no, which was no big deal, right? That they're not going to give me the deal. And I didn't know why, but they said it was because of my debt to income ratio. And I said, yeah, but all these properties have rent roll. And they said, yeah, we understand. We use only a certain percentage of that rent roll. The rest plays off of your debt to income. And now you're adding more debt and your income isn't matching. So that's what it was. It wasn't like I was making less money. I was actually making more money. But even though that was the case, the way the banks are designed, if you borrow personally, okay, which is just conventional mortgages, you will always hit the financial wall. I teach this a lot. And I did. I hit it. And in 14, I had to sell all 36 units. Me and Larissa had bought our dream house, literally over on Radcliffe. And we ended up having to sell that dream house, created a lot of problems. And here I was, right? 2008, felt like I was at the top. Pro snowboarder, had my retail shops, one of the top advisors, lost it all. 2014, 36 units, doing really well as an advisor, sold my retail shop, still pro snowboarder, life's good. 14, because the bank wouldn't give me that mortgage and froze all my lines of credit, I had to sell every single unit, and it brought me right back down to the bottom. So you see how I've learned what you're learning right now is because I've literally ridden the roller coaster of, I don't want to call it hell, but literally the financial doom. The financial roller coaster is what I rode my whole life up until I learned the secrets of the wealthy. I learned what the wealthy do with money that none of us have been taught to do. And that's part of what you're seeing. The money multiplier is that biggest secret. There's many more secrets in what they do, but this is the paramount thing that they know that we don't. They know how to make their money work the same way banks do. They know how to make compound interest, uninterrupted compound interest on their money while still having access to their money, which is what this system allows us to do. Look at that. These are the main people that talk about this. And there's more, but Tony Robbins, somebody corrected me and said it was, I think, page 5.5 in that book, Second Chance. I'll never forget when I read that book, Kiyosaki's Second Chance. I'm reading it. And all of a sudden I got to this chapter and I'm like, oh my God. He's talking about privatized banking. He's talking about what we do. Holy crap, he's doing it too? Who else is doing this? Well, our Nelson Nash developed this. He's certainly doing this to a level that many of us will never understand. If you read that book, Becoming Your Own Banker, you will understand why he is the one that created this system, how he did it, how he figured it out. And he did. Well, he didn't create it because it was created by the Rockefellers, but he took it and brought it into the normal way of doing things. Now, many of you have probably seen this, but let's just do it again. This video is so awesome because this video sums up everything that we do. So let me play this real quick. Let me play this video. I got to hit play down here.
Hey, it's me, Destin. Welcome back to Smarter Every Day. You've heard people say it's just like riding a bike, meaning it's really easy and you can't forget how to do it, right? But I did something. I did something that damaged my mind. It happened on the streets of Amsterdam, and I got really
Darn it. Sorry, folks.
scared, honestly. I can't ride a bike like you can anymore. Before I show you the video of what happened, I need to tell you the backstory. Like many 6-year-olds with a MacGyver mullet, I learned how to ride a bike when I was really young. I had learned a life skill and I was really proud of it. Everything changed though when my friend Barney called me 25 years later. Where I work, the welders are geniuses and they like to play jokes on the engineers. He had a challenge for me. He had built a special bicycle and he wanted me to try to ride it. He had only changed one thing. When you turn the handlebar to the left, the wheel goes to the right. When you turn it to the right, the wheel goes to the left. I thought this would be easy, so I hopped on the bike ready to demonstrate how quickly I could conquer this.
And here he is, ladies and gentlemen, Mr. Destin Sandlin. First attempt riding the bicycle.
All right. So the faster I go, the better. Yeah.
I couldn't do it. You can see that I'm laughing, but I'm actually really frustrated. In this moment, I had a really deep revelation. My thinking was in a rut. This bike revealed a very deep truth to me. I had the knowledge of how to operate the bike, but I did not have the understanding. Therefore, knowledge is not understanding. Look, I know what you're probably thinking. Destin's probably just an uncoordinated engineer and can't do it. But that's not the case at all. The algorithm that's associated with riding a bike in your brain is just that complicated. Think about it. Downwards force on the pedals, leaning your whole body, pulling and pushing the handlebars, gyroscopic precession in the wheels, every single force is part of this algorithm. And if you change any one part, it affects the entire control system. I do not make definitive statements that often, but I'm telling you right now, you cannot ride this bicycle. You might think you can, but you can't. I know this because I'm often asked to speak at universities and conferences, and I take the bike with me. It's always the same. People think they're going to try some trick or they're just going to power through it. It doesn't work. Your brain cannot handle this. For instance, this guy, I offered him $200 just to ride this bike 10 feet across the stage. Everybody thought he could do it.
No, you didn't understand. You didn't understand. So, this way. Okay. All right, a second. All right, so, whenever you're ready. Wait. No, you have to keep your feet on. Dude, all right, here we go. Wait. Like, you gotta start rolling at least. And go. Oh, no! All right, back up. Okay, wait. Keep your feet on the pedal. Go. Go right on. Just keep your feet on the pedals. Hands on. Yeah, come on. All right, one more time. Okay.
Once you have a rigid way of thinking in your head, sometimes you cannot change that, even if you want to. So here's what I did. It was a personal challenge. I stayed out here in this driveway and I practiced about 5 minutes every day. My neighbors made fun of me. I had many wrecks, but after 8 months, this happened. One day I couldn't ride the bike and the next day I could. It was like I could feel some kind of pathway in my brain that was now unlocked. It was really weird though. It's like there's this trail in my brain, but if I wasn't paying close enough attention to it, my brain would easily lose that neural path and jump back onto the old road it was more familiar with. Any small distractions at all, like a cell phone ringing in my pocket, would instantly throw my brain back to the old control algorithm and I would wreck. But at least I could ride it. My son is the closest person to me genetically, and he's been riding a normal bike for 3 years. That's over half his life. I wanted to know how long it would take him to learn how to ride a backwards bike, so I told him if he learned how to ride a backwards bike, he could go with me to Australia and meet a real astronaut.
Are you gonna give up?
No.
Go ahead. This is how it starts. Look at this. This is such a big deal. Get up, you got it. Did you see his brain get it? So in how many weeks have we been doing this? 2 weeks? In 2 weeks, he did something that took me 8 months to do, which demonstrates that a child has more neuroplasticity, am I even saying that right, than an adult.
It's clear from this experiment that children have a much more plastic brain than adults. That's why the best time to learn a language is when you're a young child.
All right, today's bike log. I can ride smooth, I can ride fast. I'm thinking the experiment is over. Okay, now I'm in Amsterdam, a city that has more bicycles than people. The question is, can I ride a normal bike now? I mean, I've spent all this time unlearning how to ride a bike. If I go back and try to ride a normal one, will my brain mess up? So I've tweeted a Smarter Everyday meetup, if you will, and I'm gonna see if somebody brings a bicycle and I'm gonna try to ride a normal bike. It's backwards, it's backwards.
This was one of the most frustrating moments of my life. I had ridden a normal bike since I was 6, but in this moment, I couldn't do it anymore. I had set out to prove that I could free my brain from a cognitive bias, but at this point, I'm pretty sure that all I proved is that I can only redesignate that bias.
So what you're not seeing is just a group of people here looking at me, looking at the strange American that can't ride a bike because they think I'm dumb. But I'm actually 2 levels deep into this because I've learned and unlearned. All right.
After 20 minutes of making a fool out of myself, suddenly my brain clicked back into the old algorithm. I can't explain it, but it happened in a very specific moment.
I got it. I'm back. Oh, it clicked. Hold on, it clicked. I got it. Okay, there it is. There was the moment. Okay, I can ride a bike.
I tried to explain this to the people around me, and they just didn't get it. They thought I was faking the previous 20 minutes, and I couldn't get anybody to believe me.
That looked like I faked that, didn't it?
Yeah.
Just a fake. You think I'm faking. You don't believe me.
That looks so weird. You were like, la, 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 and it's
You think I'm lying, don't
Yeah, I
you?
do.
I'm not lying.
I felt like the only person on the planet who had ever unlearned how to ride a bike, and I couldn't articulate it to anyone because everybody just knew that you can't forget how to ride a bike. So I learned 3 things from this experiment. I learned that welders are often smarter than engineers. I learned that knowledge does not equal understanding. And I learned that truth is truth, no matter what I think about it. So be very careful how you interpret things because you're looking at the world with a bias, whether you think you are or not. I'm Destin. You're getting smarter every day. Have a good one.
Okay, if you want to support Smarter Every Day,
All right. So the things you should have taken out of that video are, number 1, MacGyver mullets are making a comeback because none of us can get haircuts. That's the very first and most important thing that you should get out of that. I'm working on mine right now. You just got to kind of feather it out a little bit and it'll come out. But the other thing you should have learned is in that video, you watched somebody that had learned something their entire life, riding a bicycle the regular way, right? And how it works. Handlebars go to the right, the bike goes to the right, handlebars to the left, bike goes to the left. That's the regular way. But then all of a sudden, one change, all that happened to that bike is they made one change. And now when you turn that bike to the right, the handlebars to the right, the bike went to the left, and all of a sudden he couldn't ride it. Well, you know, when you really think about that, that's a lot like money. Your whole life, you've been taught that money works a specific way. You've been taught that money in your life is you're supposed to do certain things. And now with what you've learned about the money multiplier and what I'm going to show you today, now all of a sudden you're like, wait a second, that's not how money works. So you have to start asking yourself, what else don't you know? Well, that's when I did this Mysteries of Money. Most of you have seen this. Obviously, if I ask you the definition of money, now all of you would know the answer, right? Money is nothing more than a means of exchange. Money for food, food for money. Money for car, car for money. You get it. It's just a means of exchange. You also would understand that if I ask you what company uses compound interest, your answer would be none. There isn't a company out there that uses compound interest, but most people will say banks. Banks do not use compound interest. They charge us compound interest. They pay us compound interest, but they do not use compound interest because banks, just like every business that you've ever met, is in the business of moving money. Banks move money. You make a deposit. You take your deposit into the bank. You give it to the teller. What does the teller do with your money? Well, you might think that they take your money and they go put it in your little box in the back that has your name on it so that when you come back to get that money, you just say, hey, I'd like to take the money out that you put in my box in the back. That is not what they do. They do not do that. They move your money. Your money gets deposited. And even if it had your name on it, you're never going to see that dollar again because it's in circulation. They lend it out. They lend it out to somebody for a mortgage, for a car, for a house. You know what I mean? That they just move your money. That's what banks do. And your dollars, you absolutely by now, watching the stuff that I do, you know your dollars are worth the most today. Because especially with the Fed printing $2 trillion and everything that's happening with this coronavirus bailout, all those new dollars they're printing, the one thing you should know is it's stealing your dollars. Your dollar's value is what these new dollars are deriving their value from. So if your dollar was worth whatever, let's call it $1 is equal to $1. They print $2 trillion. Is your dollar now worth $1? No, it's worth less because those $2 trillion had to steal value from our current dollars in the form of inflation. That's what it is. Inflation is a hidden tax. It's always been exactly what it is. So your dollars are always worth the most today. However, we are not taught to keep our good dollars. We're taught to give up our good dollars. And we're taught to give up control of our dollars and give that control up to someone else so they can make money. Then you got the tax thing. Taxes go up or do they go down? Well, we know they go up. And if they don't go up, they go sideways or they just find more crap to tax us on, but they very rarely ever go down. And if that would be the case, then why do we love putting money into retirement accounts? Because we just said our dollars are worth the most today. When you put your dollars into a retirement account, what are you doing? First, you're giving up control of your good dollars today. Second, you're basically putting that money in there and you're compounding the tax because as you get older, as you build up more money, as you make more money, which you all will, your value of your 401k is going up. So that now you got a deduction today, right? You got a deduction on your dollars today, but when you take that money out, you're taking out at a higher tax bracket. You're taking that money out while your dollars are weaker because inflation's hit them. And then what I find is most people, when they do turn 59 and a half, They don't even take their money out of the retirement account because they don't want to pay tax on it. So they defer it until they have to take it out by the government, which is called RMDs. And when they have to take it out for RMDs, they get mad because now they got to pay taxes on that money. Holy crap, who taught us that that is the way that our money should work? You know what I'd like to do is erase everything we've learned about money and just teach people that the best thing you can do with money is learn how to make your money work for you today. That is a much, much better way to do it. But that's not how we're taught to do it. And that's not how the public does it, which is why so many of us remain and stay on the financial hamster wheel. It is absolutely why we do it. You guys have seen this one, right? All this example does is says, if you had 25 grand at your local bank and your bank paid you 4% in your money and you wanted to take your 20 grand out to pay cash for a car, you could do that. But if you were smart, and if I was your banker, I would tell you, why don't you just leave your 25 grand in the bank earning 4%, and then our bank will loan you the 25,000 so you can go out and buy that car. And let's just say we charge you 6%, which is 2% more than what you're making. We're going to lend that money to you over 60 months, but that's going to, your money, your 25 grand is going to remain in your bank, and that money is going to earn 4%, and it's just going to keep growing. And then if I asked you, well, is it possible to make more on 25 grand earning 4% when you're paying 6% on a $25,000 loan? Can you earn more at 4 than when you're earning or when you're paying 6? You've heard this, but the answer is absolutely. And then you just run the math. The monthly payment on the car loan is $483. The future amount that you paid for that car with interest is $28,999, but your 25 grand never left your bank account. Your 25 grand simply acted as collateral. And because of that, it was able to compound and grow on itself. And every time it earned that 4%, it was earning 4% on a higher number. And if that 4% was compounded daily, well, it's a 4% annual rate. But if it was compounded every day, you're making more than you were the day before. Therefore, you'd have more money in your bank than you would have paid on that car loan. Most people would fight me saying, there's no way you can make more money if you're only earning 4% when I'm paying 6. That would be the common way, but the math shows you something different. You made 1526. You all know the money multiplier consists of 3 things: a machine, the marathon, which is that time we need to wait to get the machine capitalized into its efficiency point. Traditionally, 3 years. We're going to look at a lot of that today. And the millionaire, okay? The mindset millionaire, or the money mindset, or whatever you want to call it. You got to want success. And this system will help you get there. Just follow the system. We all know this is the machine. And this is the part that usually blows people away. It's a dividend paying, specially designed, not your off the shelf whole life, but a specially designed whole life policy from a mutually owned company. And who else uses this? Well, banks do. And just look it up, Bully. And then over here, this showed you exactly what we're talking about. If that 4% isn't a bank, because you can't make 4% at your bank, well, that's the insurance company. They do indeed pay a guaranteed 4%. And if you borrow money from your policy, your banking policy, they're going to charge you interest. It's not 6%, it's actually 5%, but we went with 6. We only did the minimum with no dividend. And then we did the 6% because that's the highest we've ever seen. So if you're earning 4 and paying 6, you're still making money. It was just proving to you. We all know how banks work. I'm going to save you guys on this, right? Banks move your money. I already told you that. All they do is they take your deposits and our deposits and they move it over and over and over again. And in doing that, they make a little bit of money. How much? 20%. How much is 20%? If you're only earning 4, well, it's 5 times more, which means they make 500% more than we do. And banks make between 400 and 1,300% on the money we leave there. All right, I went really quick with that. So I hope to God no one on this training today has not seen the money multiplier method, because you're probably like, whoa, slow down. But you all told me that you've already seen it. So I went super quick, just as a quick recap. So remember, what we're doing is we're using a specially designed whole life insurance policy from a mutually owned dividend paying company. Well, here's one of those policies, right? Who is this policy on? Me. This is my plan. Okay. This is the plan that I designed. This is the plan that I'm going to use. This is my newest plan. This is a small one. I've got other bigger ones, but I did this one because this is what the one I'm going to do next. So remember, I've got 6 of these banking policies. And some people, when I tell them I have 6 of them, they're like, why wouldn't you just have one? That doesn't make sense. You have 6. Makes all the sense in the world. If I start a plan at 10 grand and I want to put 20 grand in it next year, I can't. I got to start the next one. So this plan is for 10 grand. Now this plan is built off of a different insurance chassis. So the machine we use is still a specially designed whole life, but this machine, this one here is designed for the sprint, not so much the marathon. So it's different than what we talk about. But I want you to see this because I'm a real estate investor. I'm experienced in the banking function. So therefore, this plan, even though I know I'm giving up something in the end, right? Something long-term, I'm going to make less money down the line, 15 plus years later. If I just designed this and gave up a little bit up front and did this on the regular vehicle that we use, which is what all my other 5 plans are, except for this one, or I'm sorry, all my other 6 plans, except for this one, are the old design, the 60% year one. This one, if you can look right here, I make a deposit for, get my cursor over here. Can you guys see my cursor? Can someone see my cursor here? I just want to know if you guys can see that right up here. Can you see it next to the rate of return? All right, perfect. So if I deposit 10,000 into this plan, now I have guaranteed values, but I also have non-guaranteed values. And the non-guaranteed values are different than the current value, the guaranteed values, because of only one thing. There's only one difference, and it's right here. I get a dividend. And just so you know, this company that I ran this with, they have paid a dividend consecutively for 163 years. Never missed one. Another thing on the dividend. Right now, 2020, the COVID economic recession, whatever you want to call it, the COVID crash is what I'm calling it. Interest rates are at one of the lowest levels ever in our history. So because interest rates are at the lowest level, what else is at the lowest level in 30 years? Dividends. So this is kind of cool looking at this because we are literally looking at this with the lowest dividend in a 30-year period. I have a sheet on that and I could prove it to you. This is the lowest dividend that they've ever paid, this company, ever in 30 years. Lowest. Prior to 30 years, they probably have never paid a lower dividend than they do now, but I only have 30 years of data. So take a look at this. Normally, when we show this, we show if you deposit 10,000, you roughly have about 6,000 available immediately in the first 30 days. In this plan, I deposit 10,000, and over here in the highlight, how much do I have available? 9,200. Well, wow, that's more than 60%. You're right. That is 92% of my money is available immediately. Now, what would I do with my money if I had 9,200? Maybe pay off a debt. Okay. Maybe I got a credit card out there that is owed 9,200. Maybe I have a commercial line of credit. True story. I take that 9,200, I can pay off that commercial line of credit. And how much am I paying on that commercial line of credit? Well, I can tell you my one line of credit is 9%. I owe a little more than 9,000, but let's just pretend it's 9,000. Let's say I immediately deposit 10,000. Okay. Today I deposit 10,000 in this plan. I immediately, within the first 30 days, take out $9,000 to pay off that line of credit. Just keeping the math simple. I pay that line of credit off for the $9,000 that's owed on it. Now, let's just say I'm paying $200 a month on that line of credit in interest in principal. Now, when that line of credit's paid off, what do? Well, I take that $200 that I was giving to the bank and I give myself that $200. I take and I repay my $9,000 loan that I just took from my policy. And in doing that, I repay myself with the interest that I used to give away to the bank. We've gone over it, but I'm just showing you now how that same thing can be done here. And every single year that I do that, I'm going to repeat that exact process and cycle. So when a client or one of you becomes a member, one of the things we do is we run you through your plan design. Now, a lot of times, if you're talking to me, I like to talk about a thing called cash on cash return. See, there's 2 types of returns that most people know about. Number one, they know about cumulative return. What is cumulative return? Well, let's look. Here's cumulative return. Over 5 years, I put in $10,000 a year. So how much is my total deposit into this specially designed whole life? $50,000, right? I put 50 grand in. So if I put 50 grand in and I have 51,126, what is my cumulative return? Well, on my 50 grand, I made $1,126, right? So if I take that 1,126 and I just divide that into 50 grand, over 5 years, I have made 2.25%. So let's round it to 2.3%. Now, how many of you would be excited to make 2.3% on your money? Probably none of you. Some of you might, though, because some of you have money in a bank account and you're earning nothing. So 2.3 is better than a bank account. But if this is how you're doing the math using this system, the privatized banking, infinite banking concept, if that's how you're doing your math, you're doing it all wrong. You're doing it completely wrong because now your mind, like that bicycle, is going back to the old way of thinking. So why would this not be the right way to figure your return on how much money you're making on this? Let's think about that. Well, think about back to what does a bank do with money? Well, the one thing we determined that banks don't do is banks do not leave their money sitting. They move the money. So if I looked at that return, 2.3% over the 5 years, that would involve and require me to do nothing with this money. It would require me to literally take 10 grand, deposit it, and never use that money, which defeats the entire purpose of doing this concept, because what we want to do is we want to mimic what the bank does. We want to move our money. And this vehicle is the only vehicle that I know of in the world. And if you guys know of something else that will do what we do here using a different vehicle, and if that different vehicle is better than this vehicle, I promise I will change all my PowerPoints, I will change all my presentations, and I will use your vehicle. And you know why I say that? Because there isn't another vehicle. And there hasn't been for hundreds of years, which is why the Rockefellers used what we use, which is a specially designed whole life. They didn't use an IUL. They didn't use a brokerage account. No, they used a whole life. Why did the banks not use IULs? Well, the banks use whole lives. Why? Because it's the only one that can do what I'm about to show you, just like this. So if you were figuring cumulative return, you're doing it all wrong because you're not moving your money. Now, how do you really use this? Well, the way I figure my returns out is a thing called cash on cash return. Now, why would I do that? Well, because I know that as soon as I deposit money, I'm able to take that $9,200 out of my account, right? I can take a loan from the insurance company and they'll just use my 10 grand as collateral. So I took that loan of $9,200 out, but I'm still making 6.2, which is the dividend plus interest as of 2020. I want to be clear. The dividend in 2020 right now with this company is 2.2%. How much is the guarantee? 4. What is 4% annualized plus 2.2% dividend gives you 6.2. So my 10 grand, 100% of that 10 grand is earning 6.2% over the year. Now, if I take $9,200 out, or in my example, $9,000, if I take $9,000 out, how much does the insurance company charge me on that $9,000? Well, some of you might think it was the 6 that I showed earlier, but it's not, it's 5. Today in 2020, just for the record, because this is recorded, this is 2020, this insurance company charges 5%. So how much did I just make by taking almost all of my money out in the first year? Well, if any of you just did the math, 6.2 minus 5, you'd come up with 1.2, and that is correct. So I literally get paid for taking my money out and using my money. Well, that's what you should be doing. Isn't that what the banks do? Don't they get paid for moving money? Shouldn't you get paid for using your money? Yeah. But what am I going to use that money for? Anything I want. I can take that $9,200 and I can pay off that commercial line of credit. Then I now just picked up 8% that I used to give away to the bank, and I take that 8% and I put that 8% back in my account, this account right here. So effectively, I just took back the money that I was graciously giving to the bank, and all I did is changed one thing, and I just decided not to pay the bank anymore, and I'm going to pay myself. I recycled and recaptured the money that I used to give away. That's all I did there. Now, how many times do I want to repeat that? The answer is as many times as I can. So year 2, I deposit 10. And how much can I take in year 2? Well, let's do the math. This is just simple math. So to figure this out, and this is how we do cash on cash return, we're going to take year 2's number, which is 19,090. We're going to subtract 9,214. How much are we able to use year 2? 9,876. Now that's not great, right? Because I don't have access to all of my money yet, but it's getting better, right? So I got 9,876. How much money am I making interest and dividends on right now? Any of you that said 20,000, you're correct. But remember, I took 9,000 out the first year. All I'm doing is I'm just making those payments back to myself. Instead of paying the bank, I'm paying myself. And that's not included in this number. I just want everybody to be clear. I'm not showing any recaptured numbers into these returns I'm going to give you, which is even more impressive. So what I'm showing you is not using your money. But let's just pretend that let's pretend you never used your money, and I'll show you the return there. And then all you need to know is if you actually moved your money like we teach you to do and like the map will show you how to do, all you need to do is add in the returns for what you do with that money. If it's 8% that you paid off for the line of credit, great, add that here. If the second year I take this 9,800 and I pay off another line of credit, and let's just say that one's 5, I add 5. But I'm not showing you. I just want you to get thinking about what I'm doing here, right? So then let's go to year 5 in the sake of saving time. If I wanted to know the real kind of rate of return, it would be a cash on cash return, which means how much money does that $10,000 that I deposit in year 5 make me? Because remember, it doesn't matter about cumulative return because I'm using the money. And you can't factor cumulative return if your money's in motion, because that's not the right way to do it. But what would be is what we do in real estate. And that is if I have $10,000 that I just put into that account, how much is that $10,000 going to earn me that year? Folks, all of you do this with your investment accounts, with your 401k accounts. You look at it. If you make a deposit this year for 10 grand, you want to know how much money did I make on my 10 grand this year, right? That's cash on cash return. So let's go there. So to do that, what we're going to do, can't talk right now. So what we're going to do is we're going to take year 5's cash value, right? We want to know how much money we have in year 5. It's 51,126. But then we're going to subtract year 4. So you just go up here and you subtract 40,055. So that means we made $11,071. You guys can do the math with me. However, that's not the right number because we deposited 10. So we got to subtract 10 from that. Can't use our deposit as part of the return. So we netted $1,071 from year 4 to year 5. That's how much we made. Now, to figure out your cash on cash return, it's easy. Take that net amount that you made and divide that into your deposit. You deposited 10 grand, right? And you made 1,071. So what is your cash on cash return? 10.7%. Whoa. You just made 10.71% and you didn't even move your money. You did exactly the opposite of what I'm telling you to do. And you still made 10.71% on your money. Cumulatively, you made only 2.3. But again, do you see the difference? We're moving this money. And because you're moving this money, the only return you really want to focus on is your cash on cash return. I make a deposit. How much does that deposit make? Because I already know I can take that money out. And also, did you guys notice that you were able to take more money out than you deposited? Well, that's going to happen every year from year 3 on, because year 3, 29,433 in my plan minus 19,090. So I deposited 10,000, but I can go and take 10,343 in the 3rd year. Actually, that's year 2 to 3. So from year 2 to 3, if I put 10 in, I can take 10,343 out. How many of you can go to your bank today, deposit $10,000, go back to that bank and take out $10,343 or $10,343? None of you. You can't do that. The bank doesn't do that. And then for sure, if you took that $10,343, I can assure you your bank would not continue paying you interest on the full $30,000 that you deposited up to that point. You see what I mean? That's where this concept gets really impressive. But let's even go one step further. Let's look at, well, actually here, let me go back to this one. Remember, I want you guys to understand. I want you to understand that I didn't move this money. If I moved this money, that return wouldn't be 10.71. That return would be way freaking more than 10.71 because I would have recaptured all the returns and would have recaptured all the interest that I'm graciously giving away to the bank. That's on top, folks. That is on top. And the only thing we need to do, and I did not forget about the interest I'm paying the bank. I just showed you 10.71. So if I made 10.71, but then I took the money all out. I took all 51,126 out. That's 5% that I got to pay on that. So if I'm 10.71, but I have to give the insurance company 5% simple interest, I netted 5.71%. Now let's look at how impressive and incredible this system is. if you had 51 grand in your bank or in your investment account or in your 401k or in your IRA, and you took $51,000 out of your account, you took it all out, how much interest, how much gains, how much dividends would you be making in all the traditional sources? How about zero? You took the money. How much are you making here? I just showed that number. That number was that number I just put up, and now my phone, it was 5.71%. You made 5.71% for taking all your money. Like, think about how stupid that is. That's not stupid at all. That's freaking genius. That is something that is worth getting excited about, is it not? But let's keep going, because like this just gets way more fun the longer we go with this. The longer we keep using it, it gets way more fun. So now let's just say that this is my plan and I'm using this. And every year, folks, every year I'm taking money out. So those returns I just gave you, those are the worst I could possibly ever do, because that involves me taking no money out and never using it and doing nothing and defying everything I teach you guys to do. But let's just say I did that. But then all of a sudden, what just happened in my life? Didn't Viviana just enter my world? She did. So what do you think I'm thinking about? I'm not thinking about what I'm making anymore. I'm thinking about, like, how am I going to make sure my little girl is going to be taken care of someday? See, my perception changed. My whole mindset changed. It's not about me anymore. It's not about the things we have. It's about her. So when Viviana is 18 years old, she's going to have to decide, Dad, well, actually when she's 17, Dad and Mom, am I going to go to, or she's going to decide whether she wants to go to school. Now, last time I checked, school's not so cheap, is it? School's pretty freaking expensive. But if she decides she wants to go to school, I'm never, ever going to open a 529 plan for Viviana. And I'm never going to open a college savings plan for Viviana's school, because all those give up control of my money. And all those plans have restrictions. Oh, the 529. Oh, darn, let's say Viviana doesn't go to school. Well, then Mr. Uncle Sam, the IRS, steps in and says, yeah, well, if you take that money, I'm sorry your daughter's not going to school, but you can go back to school. But if you don't go back to school and you take that money, we have to charge you a penalty. I'm sorry, but yes, we will have to charge you a 10% IRS penalty because you're not 59 and a half, Chris. I know, man. Actually, I'm sorry. I would be, holy crap, I'm freaking old. I would be 61. So the government wouldn't step in and say they got to charge me a 10% penalty, but what would the government say? Chris, you can use that money in that 529 that Viviana was going to use for college, but now we got to charge a tax on all of it. So here, I put the money into this, not for the purpose of college, but for the purpose of growing and using that money the way the bank does. Paying off debt, buying cars, paying for real estate deals and gap funding, BRRRR deals and everything else. And then all of a sudden I get to year 18. I can't believe I'm going to be 61 when she's 18. Let me take a sip. I don't have alcohol in here, but I should. Sorry, I digress. Anyway, I'm 61. She's 18. Let's say Viviana does want to go to school. Well, she's got $185,437 there that she can use to go to school. But here's how I would do it. You see, we would apply for FAFSA, for financial aid, because everybody pretty much does. That's what the colleges have you do. You'd fill out the FAFSA forms. Now, the FAFSA forms are going to look at all your assets and your income. So chances are I wouldn't qualify for FAFSA. But the one thing that's unique, when FAFSA looks at all my assets, how much money do I have in that red line there? How about 185 grand? So I got 185 grand sitting in cash value right now in that account that I should technically have to report to FAFSA to figure out how much financial aid she would get. But because of this vehicle, and because this vehicle is excluded from FAFSA reporting, that 185,000 is like phantom. It doesn't exist. I don't have to report that. So that's good, right? That's awesome. But not only that, how much money does this money make? Well, let's do the math real quick. Let's do the math. So we got 185, right? So if Viviana goes to school when she's 17, I don't have payments starting until 18. So let's just do the math again. So we've got 185, 437. That's how much we have in there. But in the 17th year, we had 174,028. So we made $11,409. That's how much money it grew because of the uninterrupted compound interest. Again, this is not using this money for anything. I didn't move the money yet. This is just the machine working. 11,409. But how much money did I deposit right there in the green? How about $4 grand? I put 4 grand into that plan. So how much money did my plan make? How much money did my $4,000 deposit make that year? How about 7409? 7409, and I deposited 4,000. So my cash on cash return, this is kind of silly, is 185%. Real? It is. But what would be my cumulative return? Well, we put 50 grand into the first 10, but then 4,000. My gosh, people keep calling me. I put 4,000 in from year 11 to year 18. So that would be 7 years. So times 7. So I put plus 50. I put $78,000 in there. So let's write that down, right? I put a total amount of $78,000 up to Viviana's 18th birthday. So I got $78,000 in there, but I got 185 in there. So I got 185, 437 in there, but I put 78 into the plan. So my total gain, cumulative, right now I'm playing into you guys that are looking at this as cumulative. In the 18th year for her college, I put in my cumulative return was 107,437. But how much did I deposit? 78. Divided into 78, I made, darn it, that sucks. So my cumulative return, if I did my math right, is only 137%. Yeah, well, not too bad. Not too bad. But anyway, back on to the regular scheduled program. So she goes to college, but if Viviana doesn't decide to go to college, folks, what can that $185,000 be used for? Anything. Let's say Viviana wants to go out and be a pro snowboarder, and she's on her snowboarding career, and a snowboarding career today, being a professional, costs a ton of money. Sure, your sponsors pick up some of the money, but you're still going to need to travel. You're going to need airline. You're going to need lots of hotel bills because you're going to be traveling all over. You're going to need a budget. Do you think 185 grand would be enough to fund her excursions in her professional snowboard career until the sponsors pay for it all? Darn right. But let's say Viviana does what dad always wanted to do. Viviana pursues a professional surfing career. You guys know where my head's at. I'm just laughing with this. So she does a professional surfing career. And the surfing career, all right, so the surfing career is going to cost money even more than the snowboarding career because now she's got to travel all over the place surfing. She's not going to make any money really with that until she gets really good. But can she fund a surfing career? Yes, 185 grand. But let's say Viviana wants to take over the family business and she wants to basically expand on that business. Wants to buy more real estate, wants to take the rental portfolio to wherever she wants to. She's got 185 grand to do that. Do you understand like what I'm saying? So she can do anything she wants because that money is there and was always working for her. There was never a day that money wasn't working hard for her. And she didn't even know about this. Right now, she doesn't even know about this thing, but it's there and it's set up, number one, to provide more income for us as a family. But number two, for when she's in college, it has money for that. But let's keep going because it even gets more fun. Let's look at the rates of return that we talked about. Here is your cash on cash returns. Remember, year 5, there was your cash on cash return. I put it right on the screen. It was 11%. Year 11, we didn't do that one, but year 11 is the last year that or the first year that you can't put 10,000 in anymore. So we hit the MAC limit, so we can only do the 4,000. But that $4,000 deposit in year 11 made 96% because that's the cash on cash return. This is the power of uninterrupted compound interest. It gets even better. It gets stupid, actually. So let's say dad gets older. Viviana's in school, but dad retires. Viviana wants to take on the business, and she's doing great with it. We hired a bunch of people. I don't really need to work, and I'm just looking for a little extra income for retirement, tax-free. So what do? Viviana no longer needs this money here, so I can go to this plan, and what can I do? Well, I can take a supplemental retirement. And I just did it from age 64, but from 64 to 65, how much did this plan grow? Well, let's look at it. So 64, we had 238, 662, 65, sorry. At 65, and then 63, it had 224, 181. So the plan grew by $14,000. So let's just say all I did is I skimmed the interest off the top. That's $14,481 divided by 12. That's $1,206 a month. Okay. That's not really moving the needle too much, but still that's $1,206 extra per month, tax-free, that I'm going to make. But what is my cash on cash return there? Because remember, I'm still depositing this $4 grand. I will never, ever stop putting this $4 grand in. Why? Why would I ever stop putting $4,000 in when I'm making those kinds of returns? The answer is I wouldn't, unless I didn't have $4,000. If I didn't have $4,000, well, great. I wouldn't put it in, and you don't have to, but I do have it, and I'm going to put it in. So here's my returns: cash and cash return year age 64. I mean, those numbers are stupid. You're probably looking at them going, that's impossible. No, folks, that's called uninterrupted compound interest. It's not only possible, it is logical. It is just what happens. But let's go one more round. Okay, let's do it again. Please tell me I'm going to look better than that at age 65, but that's okay. Because some of you are still thinking about that cumulative return. Yeah, I know this cash on cash stuff, but those numbers are crazy. What is the cumulative return? Well, I did the numbers. If I'm 65, I put in $228,000 over all those years, which 65 would be what? 18, 19, 20, like 21 years or something like that. So over 21 years, I put 228 in. My total cash value is $680,000. I want to remind all of you folks, this is defying everything I teach because I didn't move any of this money. I never used one penny of that money to show these returns. If I had moved this money, these numbers would be so stupid you would never believe me if I showed them to you, because then I'd be picking up the 8% from the line of credit, the 5% from the line, the 6% that I would have given away to the car dealership, whatever the 6% that I charge my company when I lend money to it. I would pay, all that would be on top of everything that you're seeing here. But the cumulative return is only 298% at the age 65. Okay. That's all. That's all I made on my money. No biggie. Nope. There you go. Here's the numbers again. We just kept going, right? Because this doesn't end. This doesn't end. I can't even kill the darn thing, but look at the numbers. The cash value, never used it. I was lazy. I never used this. I defied everything. And all I did is I just parked my money and I just let that money just keep growing inside this vehicle. Well, what are the returns here at age 75? Cash on cash. I did the math. Just do it. 423,979 minus the year before. So 74 was 402. Here it is. 423 minus 402 means you grew by 21,880. But that year, how much did I deposit? Well, I'm still depositing that $4,000. A lot of people ask, why would you do that? Well, why wouldn't you? And I'll show you. Because that $4,000 that I just put in made me $17,000. So how many times would you be able to find $4,000 if when you deposit that $4,000, it turns into 17,880? Really, I don't even think I have to ask that question. So there it is. It's a 447% cash on cash return. But I'm 75 at this point. But you know what, folks? Listen, I talk to a lot of 70-year-olds about the money multiplier. I talk to tons of 70-year-olds. They're still doing great. They're still going out there. They're camping. They're doing all sorts of fun stuff. Folks, life isn't over at 75, so therefore your money better be freaking working for you at 75. Your money better be working for you now. Your money better be working for you 10 years from now, 20 years from now, 30 years from now, 40 years from now. This is the magic of your money working for you in a way that isn't even the best way to show it, because I'm not showing you any recaptured money in here. Now, this is where I did this for the real estate investors. So I have a lot of real estate investors that I work with, and they have a bunch of money because they're playing with real estate dollars, right? I just talked to a guy the other day, just is selling a house. It closes June 6th. And he's making 200 grand. And he said, Chris, where do I put 200 grand? I talked to a woman this morning. She had 400 grand. Where do I put the 400 grand? I don't know. Look, at people have money, but their money's, they don't know what to do with it. It's just sitting there. So instead of me always just showing 10,000 or 5,000 or 25,000, I figured let's look at a big plan, right? Maybe one of you wanted to see the big numbers. Well, here it is. And I'm going to get to these questions if Steven's not already tackling these, but be careful. Cindy said, be careful. Those, if you're close to 61, can't believe. Oh yeah. Thank you, Cindy. Yeah, I know. It's just nutty. It's nutty. But here's 100,000 folks. This is the same plan. Same plan I just showed you. All I did is I got rid of year one. Okay. Cause I'm just trying to show you this. This is the same plan we just looked at. This is that's specially designed whole life that's designed to give you 90% access of your money in the beginning. But you guys just saw the numbers later in that plan, right? They weren't bad. Well, did you know something? If I showed you that same plan with the regular vehicle we use, where you only have 60 to 70% year one, all those cumulative returns and cash on cash returns, like at Vivi's college and beyond, they'd be way more than what I showed you. But hey, I'm not upset with those numbers if you're not. So here's 100 grand. We put 100 grand into this. So by year 2, we put in 200. So year 2, you have 191. Year 3, you put in 300. You have 295. Year 4, you put in 400,000. Oh, you broke even. You made 2,000. So this one's done a little different. I just want you to know, but it's just bigger numbers. 402, year 5, you've got 513. So you made 13,000 on year 5. So now all I'm going to do is I'm just going to show you the cash on cash returns. That's all I'm focusing on here. I just want you to know how much money your money's making for you every step of the way. Here we go. Year 3. If you took those numbers and you took year 3 from year 2, 295 minus 191, you'd make 3,867 divided into the 100 you put in, you made 4%, which is exactly how much we tell you the guaranteed interest rate is, right? Now, one thing you guys might be missing here, you might have missed that in the beginning. And can I go back just one sec? I missed something very important and I can't believe I freaking missed it. And it's something so critically important. Where's Viviana's college plan? At the age of college. So you guys might be looking at the early years where, yeah, but I don't have access to all my money, blah, blah, blah. I still don't like this. Well, don't forget one thing. And I did, because I'm so used to talking about the banking, but let's just say at 18, when Vivi's 18, Vivi and Dad take a trip out to Baldface. It's a beautiful place. You have to heli up, and it's just the most beautiful mountains. And we're riding the POW in the backcountry. And Dad's got a little, he had a Red Bull. Dad had a Red Bull at age 61, and there's this big cliff. And Viviana goes to the left, takes the smaller part of the cliff, and Dad's like, no, I'm going to go for the 50-footer. Dad goes off the 50-footer, forgot that he was 61 years old. It was a happy graduation, right? I don't make it. I went for a rodeo or a cab 7 or something, and I just forgot that I was 61, so I didn't make it. It's a sad day, but my family gets $488,000 tax-free. You see, I've been forgetting to mention that has some value, right? I leave a legacy. That $488,000 is going to fund a lot of trips to Baldface for Viviana. $488,000 is going to really help my family to maintain their lifestyle. It's going to help pass on my legacy. I could literally say that $488,000, if all we did is put that in another banking policy for Viviana, she could get a check every single day for the rest of her life in my memory, right? Like, that's powerful. She'll never forget that. But let's say Viviana has kids. I could have a check sent from her grandfather that she never knew, that every single day or every single birthday for Viviana's son or daughter, a check shows up in their name saying, happy birthday from Grandpa. And they didn't even know me, but my memory lives on because of this planning I did. Like, that's powerful. I can't believe I missed that. It's actually sad, but it's powerful. So the $100,000. So for any of you that were looking at it saying, yeah, year 3, I'm only making 4%. I don't even have access to all my money. Let's not forget that there's a $4.4 million death benefit. Now, I know that's not why we do this. That is clearly not why we're doing these banking policies, but could it be an added bonus? Yeah, $4.4 million. If a real estate investor had the kind of premium deposits to make here, $4.4 million might just pay off a lot of their mortgages on those rental properties, putting them in a really, really good place. But the returns aren't so shabby either. Year 3, they made 4% cash on cash. Year 5, 11%, just like the plan I'm doing. Year 11, 105% cash on cash return. This is how I do things, folks. And I put this as like a bonus round. I drew this because I want you to understand how I move money through my banking policies. Now, again, all those policies that I just showed you, okay, those plans, those returns do not show any of that money moving. They do not show any recycle recapture. They do not show me taking loans, using those loans and recapturing and putting any money back in. That is just the machine working in its most natural state, and it is doing everything I'm teaching you not to do. You need to move your money. That's what we do this for. We want to mimic the bank, and you've got to move your money. I know I'm saying this over and over, but folks, this is so important. Here's how I do it. Take a look at this little drawing. This is me. What I do is I make deposits into my banking policy right there. You saw me making my $10,000 deposits. Year 2, and I'm just go with the numbers. Let's say I got 20 grand and I take $20,000 as a loan. Now, how much am I making on my 20 grand? 4% plus dividend. As of 2020, it's 6.2% for the insurance company that I'm talking about. Okay. I take a loan for 20 grand. How much is the insurance company going to charge me? Well, as of 2020, 5%. So I take that loan and I have that insurance company send that money to my bank account. A lot of people ask me, so how do I get money out of my plan? Well, that's a really complicated thing. It involves you making a phone call and saying, hey, can you send me some money? That's it. Hey, Chris, or hey, Jonah, yeah, can you send me 20 grand for my plan? Great. Yeah. All right. Perfect. Thanks. I know that sounds funny, but that's what it takes. But let's just say you don't want to pick the phone up. You just don't feel like taking a call today. Great. Log into your banking policy, log into the insurance company and your account. As soon as you put your password in, it pulls your account up. Click policy values, click loan, put in 20 grand, click OK, verify what account it's going to. I want it to go to this bank account. Great. 36 hours later, the money's in your account. Great. So here's the money, that 20 grand transferred 36 hours later from my banking policy into my segregated account. Now, what am I going to use that money for? Well, Larissa, one of her friends, is selling a house and we're buying it for 100 grand. This isn't real, but I'm just going with it right now. I'd like to get it going for 100 grand. We're going to rent that house out. We have a renter already in place for that house. So what I'm going to do is I'm going to take that property. I'm going to take that property to the bank, my community bank, and they're going to give me 80% of loan of the purchase price, which is $80,000. I'm short 20 grand. But oh, whoops, I've already got 20 grand sitting in that segregated account that was in my banking policy. So what I'm just going to do is I'm just going to scratch up a note, a promissory note from me, Chris Naugle, to my entity. And I'm going to do it for 20 grand and I'm going to charge my entity 6%. That's all. It's fair. My bank would charge me more than 6% probably. So I'm going to charge 6%. So that agreement, and it sounds silly, but this is how I do it. That agreement is between me and my company. Now I own the company, but still I want something in paper saying my company owes me money. So I do that note. Now the deal closes, the property closes, we move that tenant in, and now that rent roll is being deposited on a monthly basis into my entity's corporate bank account. Then what I do is I just go into my corporate bank account and I click a thing called bill pay. And I set up a payment equivalent to 6% of that $20,000 that I lent. And every single month out of the rent roll, my company mails me personally a check equivalent to 6%. Now that could be 6% interest only. That could be an amortized loan, which is how I do them. I do them 6% amortized over however many years I want, depending on the cash flow of the property. You can do whatever you want. I do that. Now, all I did here, folks, is I started one of those stupid, specially designed whole life policies that we've been talking about. Then I put deposits that I would have put somewhere else into that policy that earned that return. I then just take loans out as fast as I can. I take money out and I then go buy real estate or I do whatever. And all I do is I just practice what I preach and I'm an honest banker. I recapture the money that I was giving to the bank over and over again. And I put that money, and all I do is I just take that money and I put it back in my banking policy. And then I go find the next deal and I do the same thing and I repeat the process, and the next deal and I repeat the process. And let's just say me and Larissa decide to sell this rental because we get a really good price. All I do is I take whatever was owed on this note that wasn't paid off and I deposit back in the bank account. Now, all of a sudden I've got all this money and I gotta just keep using that money and repeating that process. That's how I do it, folks. That's simple. Truly, there's nothing hard about this. It's all automated. I set up bill pays. I do everything online with bill pays. I take loans from my policies with online. I log in. I did one yesterday. No, 2 days ago or 3 days ago. I took 25 grand. I put it into my investment account, my brokerage account at TD Ameritrade, and I bought oil. And what am I going to do? I'm going to recapture the dividend in the interest payments that I get on my oil positions. That's all. This is where your money is right now. You want to know where the money comes from to put into your banking policy? Well, here it is. How about the money you're putting into a savings account today? How about the money you're putting into a 401k? Let's back that down to the minimum, which is the match. Just to put in just the match amount to get the money free from your employer. Take the difference, shift it over to the banking policy. You putting money in IRAs? Well, consult with your accountant, your CPA, and your tax professional. If you're not getting a big tax gain from that, well, wouldn't it make sense to maybe shift the money from your retirement accounts into this? I just showed you the numbers. Sure does. Savings, bank, checking, Christmas clubs. You're making nothing. That's money. And are you making extra payments toward your credit cards, toward your mortgage, toward your car to try to pay that sucker off quicker? Stop. pay just the minimum to the credit cards, take the difference, put it in the banking policy, use the banking policy to pay the credit card, use the banking policy to pay off the credit card, use the banking policy to pay off the mortgage, use the banking policy to pay off the car. That way, all of your money now is earning interest plus dividends, even though you're taking it out. I just went over the numbers. This is all the same thing. The guideline minimum, a lot of people ask, what is the minimum amount I can put into a banking policy? That's a great question. It is your age times 10. So I'm 42. So 40, well, I'm almost 43, but 42 times 10 is 420. That would be my minimum. If I'm under 30 years old, that minimum guideline is 30. Well, if you're under 30, it would be your age times 15. If you're over 65, it's your age times 15. So you can see 60 times 15 would give you your minimum. 20-year-old times 15 would give you your minimum. Then a lot of people don't understand that not only can they make regular deposits into their plans, annually or monthly or quarterly or semi-annually, however you want to put the money in. It's however you're depositing money now. You can also take money that's just sitting there lazy in your bank account, and you can do dump-ins. What happens when you do a dump-in? Nothing. You're dumping the money into the account, your specially designed whole life. You're dumping it into the insurance company's general account through a special rider. And now that money is now earning interest and dividends. Oh, and the best part, that dump in, you now have access to pretty much almost all of that money as soon as you put it in there, because that's not part of the regular thing. So even if you didn't have the 90% plan I just showed you, that specially designed plan, let's say you have one that's the 60%. If you dump money in, you're going to have access to more than 90% of that dump. Just telling you how it works. That supercharges your plan. Now, whatever that dump in is, let's say it's 10 grand extra on top of your regular deposits. So if you did a plan where you're dumping in 10 grand and you're doing $1,000 a month, you basically would have access, and I did the math, to 9,600 of that 10 grand. That's it. And you all of a sudden now are making interest on the whole thing. So I could go on and on about this, but pretty much that is the presentation. I just wanted to show you guys a different way of looking at how this works. So pin that. So let me look at some of these questions that we have here. Do we have any good questions, Stephen? Stephen, do you want to unmute yourself?
Hey, I'm here.
Any
We just had
good
one,
questions?
not much really, just, Robin was asking, can she use this concept? I don't know if she already has a policy maybe.
Okay. So Robin, can I still use this concept if my cash value shows 5,000 out of the 12? Absolutely. Sure. Yeah, you could definitely do it. I mean, that's just one of the traditional plans. You certainly could use this. I mean, it's all the same thing. It just depends on how much money you have. I just showed you a plan that gives you more upfront, less later. Let's see, be careful. Those of us close to 61 can't believe we were there earlier. Yeah, I know, time flies. Jeff said, if you don't have the 4 grand, borrow it. I got a lot of people that do that. I don't teach that, but it does work. We show you how to use a home equity line of credit and then fund your plans with the home equity line of credit. That does work too. Let's see. So if the minimum annual it's monthly. So let's see. So the amounts that I was doing for those minimum, the guidelines, the 420 a month, that would be monthly. So that 10 time or 15 time age, that's going to give you your monthly minimum. Let's see. Can anyone put in a larger amount the first year and then do minimum? Yeah. I mean, there's rules. We got to design it around the rules of the IRS, which are the MEC rules. But sure, someone could deposit a larger amount with the dump in the first year only, and then just make, minimum or smaller monthly deposits. I do that all the time for people. And that supercharges your plan, because now you got that dump in, which now all of a sudden is earning interest and dividends. So now that really makes your returns go up much quicker. I didn't show that on it. I wasn't doing a dump in. Ronnie, let's see. Is this going to be available on a recorded replay? It sure is. Yep. He wants to see it 5 more times. Why not make it 10? All right.
We did get a question also. They're asking where they can buy a policy. So
that's easy. All right. So for any of you that are watching this, that really think this is something that would work for you and you want to talk to us and ask us questions, because there's going to be a lot of questions you're going to have. This is easy. Pull your phone out. And what I want you to do is I want you to go to your texting. Everybody knows how to text. Go to text. What I want you to do is I want you to put 33777 in your text bar. 33777. Stephen, you can put it in the chat. 33777. And then what I want you to do is I want you to text in money multiplier. all one word, money multiplier. Now, when you do that, instantly, you're going to get a message back with asking for your first and last name. I don't want to call you and say, hey, I got a call scheduled with you, but I don't know your name. So give me your name. So I'm going to put Chris Naugle. Once you do that, it's going to then send you back a message. Great, got your name. Now enter your email address. Okay, Plasm 2003. Now, why would we need your email address? Well, when we make an appointment for you, and it's a time that you pick, we're going to email you that appointment. Novel idea. Bingo. There you go. There's my calendar. There's my team's calendar. Get on our calendar and we will call you and answer all your questions. That's how it works. So 33777 and just type in money multiplier. And that's how you get on this calendar. And all we're going to do when we do this call, just so everybody's aware of what's going to happen, it's not some sales pitch. Okay. There's not going to be any sales. Actually, it's just us asking or answering your questions. Whatever questions you have, we will answer them. If this is something you want to do after that, this is where it gets tricky. You will have to ask us what the next step is. We are not going to say, are you ready to go? Are you ready to go? Could you ready? Pull out the checkbook. Are you ready? We do not do that. We will not ask for your business. If you want this, and this is something you want to set up for your family, for your life, for your business, just say, what is the next step? And if we've answered all your questions and we've taught you how this system works, we have done our part, and we will just continually keep teaching you and showing you how to better yourself and better this system over and over and over again. So that's how we do this. The best part of the recording is yes, you can. I know I talk fast. So I'm from New York. I've been told this a million times. I talk fast. When I get excited, I talk faster. So if I'm talking fast, it's because I'm freaking excited about what I'm showing you. So good idea, Cindy. Take her down a notch. Take her down to 0.75. Wendy's already part with us, and she's been doing great. But yeah.
Robin's asking about if she can do it in her 70s. So that's good. Maybe talk about it. You can do it on any life as well. So
correct. So, when someone's in their 70s, depending on your deposits, it may or may not work the way you want it to. It doesn't matter how old you are. It's going to work the same for a 70-year-old as it is for a 30-year-old. The cash is going to be the same amount. A 70-year-old will have a lower death benefit. But what we do a lot of times for, people that are in their 70s is to get the biggest benefit for you. We just say, do you have anybody that you love? Somebody that you trust, somebody that you'd want to do something nice for? We borrow a life the same way the banks do it. So if somebody in your life, a child, a grandchild, borrow their life. Have them be the insured, which is giving them the gift of a life insurance policy on them, because that's what they're going to get out of it. And then you control the cash, everything I showed you, you're in control of that every day of your life, but you're not the insured. So they're the insured, you're the owner. And with ownership comes control, and with control comes what you just saw. So that's how that works. Oh, I keep getting an error on the text? Really? I just did it. Let me do it again. Connie, here, I'm going to type it in. So type in your text 33777, and then what you're going to do is then after that goes in, just put in money. Something must have been spelled wrong. Multiplier. So let me do that. There you go. Oh, kind of got it. So
got it.
All right. Any chance you can show the difference in the policy you showed and the more common 60-40 split? That would be cool. I can't do it right now. I just don't have it side by side, but I'm happy to do that in the next training. I'd be happy to put the 60-40. They're both, and just so you know, Chris, both of the designs we do are both 60-40 split. So I'm glad you know that. They're both built the exact same way. It's just a different chassis. It's just a different whole life that we use. Actually, Stephen, make a note for me to run a sample illustration exactly the same as mine I have it on my desk because I have my old plan, but I don't have it right here in front of me. So I wouldn't be able to show that, but that's a great idea, Chris. Just do like a quick training, after next week and just show here's the one, here's the other. So you can really see the difference is going to be what year were you asking about? Say year 25. Ooh, it's going to be a pretty big difference. I don't remember how much money I had. It was like 400s. It was in the 400s. You probably, if this plan, let me just put it this way. If this plan had like 480 when I was 65, and I'm just making that number up, that plan would probably have 515, 520. It's a pretty big difference. It really is. And it's a great question that Chris is asking there, because I did mention that early on, that this plan looked really stinking good, didn't it? There was no one on this that watched that thought that that plan wasn't an awesome plan. But that plan doesn't hold any water in year 25 to the regular plan design where you get 60 to 70% upfront. And again, Chris, they're both 60-40 splits. Thank you, Ron. You have a blessed day as well. And I'll give Viviana a little kiss and a hug for you. And then Cindy said, if I borrow a life like that, you bequest the ownership. No. Oh gosh, no, Cindy. No. You do not give up the ownership. You are in the ownership position. You are in the driver's seat. You're in the driver's seat. The only thing that isn't happening is the insured body is not you. You are the owner. The insured has zero control. Think of the bank, right? How does the bank use this? Well, the bank promotes a VP. The bank then goes out and buys one of these policies on that vice president's life. They're the insured. The bank is the owner. The VP, what do they get? A fully paid up life insurance plan. What does the bank get? Access to the money. And the VP also usually gets a deferred compensation plan. So the bank promises to give that VP a paid up life insurance plan and a deferred comp someday, 20 years down the line. So the bank's in the ownership position. So someday later, when that employee dies, the beneficiary is that, for part of that is the employee's family, but the other beneficiary is the bank. So you would be the same way, Cindy. You would just be in control the same way the bank is. You're just not the insured. Connie said, I don't have a Social Security, only an ITIN. I believe we went over this the other day, Connie. I believe if you're a U.S. citizen, and I guess I get confused on the TIN numbers, but if you're a U.S. citizen, you have a bank account here and you have an address here, yes, the answer is. How do I make money? Or even if it's a temporary, then that still works. How do you make money when paying the insurance company loan back with interest? I just showed that, Mike. So just do the math. I mean, 6.2, or let's do year 5. So here, let me go back because this is an important one and somehow we missed that. So I just want you to understand this, Mike. So let me just go back in my slides. Come on. I'm going to go back to the $10,000 plan here. Let's use this one. Crap. I went way too fast. I knew that was going to happen. It's one more. Sorry. Give me 1 sec, Mike. Sorry. There we go. So year 5. So Mike's question is, how do you make money when paying the insurance company loan back with interest? So how do I make money paying the insurance company back with interest? Well, okay. So just take year 5's rate of return. The cash on cash return is 11%. If I got to pay the insurance company 5, what's my net? 6, right? So I'm making 6%. But then let's say I'm paying some of my loan back. That's fine because the loan repayment, the principal repayment of the loan, you don't have to pay that back. But if I did, that's coming from whatever I do with the money. This is just the machine, Mike. This 11% is just the machine working. When you take money out, or when I take money out, like I showed you in the last slides there, I'm using that to make more money. Okay. Maybe I'm lending it to LLC at 6%. So remember, the machine is going to cover the interest cost to the insurance company. That 5% is already taken out. Okay. You made 11%, but really it's 11 minus the 5. So that's your net. But then you got the 6% on the money you use. That money's coming back, and that's the money that's used to pay down that loan. So hopefully that makes sense, but you're always going to come out ahead. You almost can't not come out ahead. It just doesn't work that way. So hopefully that answers your question, Mike. Let's see, Connie, I'm planning to refinance my home next month. We'll start policy. Perfect. Yep. That's a great way to do it. A lot of people will do that. And just always remember, right? You might want to look at it in the sense of where you're using that money and you're the owner and someone else is the insured. It might work better in that way. Let's see, talking about the beneficiary. Yeah. So Cindy, I was talking about that. So I'm not talking about the beneficiary. I'm talking about the insured. The insured, I'll tell you 1 sec, Chris. The insured that we're talking about is not, they could be the beneficiary, but not when they're the insured. I'm just talking about someone that's insurable, right? If you're not insurable, then find somebody that is, and then get them to agree to basically be the insured on your policy. Obviously, it's got to be someone that you know, like, trust, that's your family. A child, perfect example. So you can insure a child, and let's see, it is likely you will die. Yeah, of course. So Cindy, if you insured a child, like if I did this with Vivi and Vivi was the owner, or I'm sorry, Vivi was the insured instead of me. I showed you doing this with me being the insured because I'm the one that I want to protect, not Vivi yet. But if I did this using Vivi as the insured, Vivi's going to outlive me. So Vivi, when when I die, I have a will, and in that will, it just gives ownership to Vivi. Or when Vivi turns 20, I just change ownership from me to Vivi. So Cindy, you could just change ownership anytime, but you can maintain ownership as long as you want. And then if something happened to you, just have a will or a trust that determines what is going to happen when you're gone. The trust would be a great way. You could make the owner your trust instead of you. So that's how we do this. So yeah, who gets ownership of the policy? Whoever you want to get ownership of the policy. The ownership can be changed. The insured cannot. That insurance company I showed you was Mass Mutual. So that was a Mass Mutual plan, but we also use One America, American United Life, and we also use Lafayette Life and a couple others. My ex gives me alimony and child support. Can I insure him? Yes, you can. Whoever said that one, that is a great question. And actually, I've had that happen many times. So you're getting alimony and child support. So you have an insurable interest in your ex for your children. So can you insure him? Yes. The question is will he allow you to insure him and you be the owner? Well, I'll leave that one up to you. Let's see. So if I borrow a life, is there an age limit for a child? I think it's 1 month old. I can double check. Definitely not more than 6 months old, but I think 1 month old was it. But let's just say 6 month old for right now. Do they have to have a medical exam? Can you imagine doing a medical test, blood draw and a urine sample on a 6 month old? Yeah, there's no medical test on kids. But great question. Great question. Let's see. There we go. Season policy. Yeah. So Cindy, like it's the gift that keeps giving. I was talking to a guy the other day. His parents bought him a whole life back when he was a young kid. And that whole life now is, he gave me the amount. It's worth a stupid amount of money. And it's just because his parents started this old New York life, whole life policy for him. And he still got it. It's the gift that keeps on giving. Like, you guys ever see National Lampoon's Christmas Vacation? What was his name? Oh God, I can't think of it. It's right at the top of my tongue. That's the gift that keeps on giving. You guys remember that part in the movie, but anyway, yeah, exactly. I'm just trying to be stupid at this point. If any of you remember like the names in that, I can't believe I'm forgetting it. It's my favorite movie. Yeah, but not Chevy Chase. What was his name in the movie? And what was his brother I think it was his brother-in-law's name. Yeah, Cousin Eddie. That was Cousin Eddie. And what was Chevy Chase's name in National Lampoon's? See, I love movie trivia. Somebody will give that to me. But yeah, Cousin Eddie was talking to Chevy Chase and he said, Clark. He said, Clark, that's the gift that keeps on giving. All right. So the other one is if the insured's life we borrow passes before. Oh, that's a great question. So if the insured dies before you do, there will be a death benefit paid out. The plan will just become a paid out death benefit. So typically the owner is one of the insured or one of the beneficiaries on the plan. So then that money would just pass over to you as the owner, and that's that. So on the dump in part is going to be a MEC. Not if we design it. We will never design a MEC plan. But if you didn't know what you were doing and you just did a dump in into the plan and it was an unscheduled dump in, yeah, you'd MEC the plan. So when we do dump ins, we have to build the plan to accept those dump ins. Great question, Wendy. All right. Chris, talking about Cousin Eddie. No, sorry. Can you insure your children if you don't have a policy on yourself? No. You cannot. So you do have to be insured yourself. That's like more of an ethical thing. The insurance company would look at that. And if you're insuring your children, but you don't have insurance, and they would say, oh no, that doesn't seem right. There's something that doesn't make sense there. So great question, Chris. You cannot insure your children if you're not insured yourself. The other thing too is, and this is loose, there's rules with this, but you really, if you have one child and you insure that one child and you have another child and you don't insure that, there's only so long you have before you insure both children. They have to be insured the same. So if you have multiple children, essentially the insurance company, if they know about it, they're going to want all the children insured, because obviously that's another ethical thing. Like, well, why does Jimmy have it and Susie doesn't? Do you not like Susie? If you like something Jimmy did bad, like, you know, I hate to get morbid about it, but like, that's why. Can't insure child, even if you are I don't understand that one. Cindy, is that worded right? Can't insure child even if you are uninsurable. Should it say, can you insure a child? Yes, you can insure a child. You can insure a grandchild, even if you're uninsurable. You're just going to be the owner. The insured is the only person that needs to be insurable, not the owner. Connie said, I need to replace my AC. Would it make sense to take out this policy and use that to fund my new AC? It certainly would, Connie. If you were going to, how are you going to fund the AC now? A credit card, a loan, a home equity line? If you were going to use any of those, then absolutely use your banking policy and then pay yourself back the same amount you would have given the credit card or the home equity line. If you're going to pay cash for the AC, I still would make an argument that this might make more sense to make the deposit, pay the AC, but then you're missing that recapture part. You're welcome. Thank you for being here with me today. Yeah. So Connie, holy crap. Yes. This is how you should pay for your AC based on that. A credit card would not be a smart choice, but here's another way, Connie. Yeah, that was Connie. Let's just say you had to put the AC in now because it's hot and your banking policy doesn't have enough money in it yet to fully fund the AC. Use the credit card and then use the banking policy to pay off the credit card. Hell, then you get some airline points. That's how I do that a lot. I use our credit card for a lot of things, and then I just go in and take a loan and pay off the credit card. If you have a whole life 20 pay, do I switch over? No, absolutely not. Teresa, great question. So Teresa is saying she has a whole life 20 pay, which is a good plan. I don't know if it's Mass, New York Life, or who it's with, but that's a great plan. Would you replace that plan with a new one like the one I designed? Absolutely not. I would never do that. And I would never do that simply for the sake that you have a great policy, and that policy that you have, that 20 pay, will work. It won't work nearly as good as this, but what we would do is just say, if you like this concept, add a second bank to your portfolio. You've already got one. Add a new one designed this way. And then what we do is we'll use that 20 pay and your new plan, combine them, and we'll do the maps for both. So I would never get rid of an old one. As a matter of fact, I have an old New York Life whole life 15 pay, and I still bank that one. It doesn't work as good as this, but it still works. So no, Teresa, don't ever get rid of an old whole life, ever, ever, ever. And we are not in the business of replacing stuff. We never tell people to replace their policies. And IUL, I might make a good argument that they should, but I've even told people not to replace them. I don't know why, but I did. They can be good retirement vehicles. You said you can't insure your child if you don't have insurance. Yeah, but Cindy, you're uninsurable, so that's different. So there's always an exclusion, right? So Cindy, you're uninsurable. So if you're not insured, can you insure your child? Yeah, you can't get insurance. So obviously, yes. We would just have to prove that you're uninsurable. And there's just some little hoops we'd have to jump through. That wouldn't be a problem in that case, because then there's not like something where they're going to say, well, why don't you have insurance and your kids do? So again, it's loose rules. These rules they're like the gray area. They're not black and white. So yeah, Cindy, you wouldn't have to worry about that. Man, these are great questions. These are those kind of questions I don't get very often. All right. Well, if nobody has any additional questions, I'm going to stop the share and I'm going to stop the recording.